2025 has been one of those years that messes with investors' emotions. We kick things off with fear everywhere. Tariff headlines, sharp sell-offs, and people calling for a recession. Then something unexpected happened. The market didn't just recover, it sprinted back to new highs. Indexes looked strong. Headlines were loud. But here's the part most people missed. Not every great company came back with the market. Some businesses quietly improved. Better cash flow, stronger balance sheets, smarter strategies. But their stock prices? Still stuck in the past. And that gap between business performance and stock price is where long-term opportunities usually hide. So today, we're going to talk about a small group of high-quality companies that did not explode upward with the rest of the market. And more importantly, why many long-term investors believe these stocks could see meaningful rebounds heading into 2026 and beyond. Now, quick clarity before we go any further. This is not a buy these stocks now video. This is about process, not predictions. Most investors only chase what's already gone up. They see the index up double digits and assume they're doing great. But markets don't reward attention. They reward discipline. Some of the best investments are companies doing the right things while nobody is paying attention. That's exactly what we're focusing on today. I recently came across an analysis highlighting several well-known businesses that had solid operational performance but disappointing stock returns. Instead of blindly agreeing or disagreeing, I want to do what we always do here. Slow it down. Break it apart. Look at fundamentals. Look at valuation. Then decide if the story matches the price. Because investing isn't about exciting stories. It's about what a business is worth versus what the market is charging today. Out of that list, I'm going to walk through 3 companies and show you how I think about them using a principle-driven approach. Not hype, not guesses, just business logic. Let's start with Nike. This is one of the strongest consumer brands on the planet. Global reach, deep customer loyalty, high-margin products, and a name that still dominates culture, not just sports. But the stock hasn't reflected that strength recently. Nike's in the middle of a reset. New leadership, a sharper focus on core sports like running and basketball, clearing old inventory, simplifying product lines, improving distribution both direct to consumer and wholesale. These kinds of transitions are messy in the short term. Margins get squeezed, earnings look weak, analysts panic. Personally, I don't care. Short-term pain during a real business reset is often where long-term opportunity comes from. When I look at Nike, I'm not asking what happens next quarter. I'm asking what this business can earn consistently over the next decade once things normalize. Nike still produces strong cash flow. Its returns on invested capital remain well above average, which tells me this is a moat business. That matters a lot for valuation. Revenue growth hasn't been impressive lately, but profitability over long periods remains solid. That tells me the brand power is still there. So the real question with Nike isn't, is this a good company? It's, how much should you pay for a great company going through a temporary rough patch? At today's prices, Nike is no longer expensive, but it's not obviously cheap either. That puts it in a watch and wait category for me, a high-quality business that becomes very interesting if the market gives us a little more fear. Next up, Amazon. For a long time, I misunderstood Amazon. And honestly, a lot of investors still do. People see retail margins and assume low profitability. What they miss is where the real money is being made. Cloud computing, advertising, logistics infrastructure, artificial intelligence. Amazon is not optimizing for next year's earnings. They're building systems meant to dominate 5 and 10 years from now. Their capital spending looks scary on paper. But when you actually dig in, you realize something important. Most of that spending is intentional. Data centers, automation, AI infrastructure. That's not waste, that's positioning. AWS continues to be a profit engine. Advertising is quietly becoming massive, and efficiency improvements in fulfillment are starting to show up in margins. This is a business that intentionally suppressed profits for years. Now the lever is slowly being pulled in the other direction. From a valuation standpoint, Amazon is tricky. Profit margins are still expanding, which means traditional metrics can mislead you if you're not careful. So instead of asking, what does it trade at today? I ask, what could normalized earnings look like if margins stabilize? Under reasonable long-term assumptions, Amazon starts to look fairly valued to slightly undervalued, depending on your growth expectations. Not a screaming bargain, but a business with a massive moat that I'd be happy to own at the right price. Finally, let's talk about Starbucks. This is not a hyper-growth story anymore, at least not in the US. But that doesn't make it a bad investment. Starbucks has something extremely valuable: habitual customers. strong pricing power, a brand that functions almost like a daily subscription. They continue to expand internationally, especially in China. They generate steady cash flow, and they reward shareholders with a growing dividend. Yes, costs are rising. Yes, competition exists. But Starbucks consistently earns high returns on capital. That tells you something important. This business knows how to turn investment into profit. The stock price, however, has struggled. And that's largely because the market wants excitement, not consistency. When I run Starbucks through a long-term valuation framework, it looks like a business priced for modest expectations. Not cheap, not expensive, just misunderstood. For income-focused investors or those looking for stability, rather than fireworks, Starbucks deserves attention. Here's the big takeaway. Most investors lose money not because they pick bad companies, but because they overpay for good stories. The best investors flip that mindset. They look for strong businesses that temporarily fall out of favor. Then they wait. Valuation is your filter. Patience is your edge. You don't need to predict the next big winner. You just need to avoid paying too much for quality. If you want to learn how to analyze stocks this way step by step, keep following the process. Because once you stop guessing and start thinking like a business owner, investing becomes a lot less stressful and a lot more rational.